20s has roughly $10,000 saved for retirement. With a portfolio that size, how much dividend income could you expect to receive? While $10,000 won't be enough to fund a typical retirement, you might be surprised at how much it would pay in dividends alone. Perhaps it would be enough to supplement your income or pay for a vacation. Take a look at the different scenarios that would provide different levels of income. This will provide a preview as to how much money you'll actually need to become financially independent. Watch to the end to learn about a major mistake some investors make and how you can maximize your investments for exponentially more money in the future. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. There are many investment options that provide varying levels of dividend income. Perhaps the most common investment is the S&P 500 index. This is so popular because it provides exposure to 500 large U.S. companies that have a history of stability and profitability. It's also well balanced, meaning that you own parts of each sector and industry that make up the entire stock market. The S&P 500 has a long track record of healthy returns and is highly recommended by Warren Buffett. This is what investors are most commonly referring to when they say the market. If you purchase an ETF or index fund that tracks the S&P 500, you'll receive a dividend yield of less than 1.5%. The reason for this is because many of the largest holdings are technology companies, which are known for paying little to no dividend. With a $10,000 investment, this index would only provide about $150 per year or $12.50 per month in dividends. Another one of the most common investments is the Dow Jones Industrial Average, or the Dow. This is another index that investors commonly refer to as the market, typically second to the S&P 500. The Dow is made up of 30 of the largest U.S. companies and is seen as a second indicator of how the United States economy is doing. Investors could purchase a fund that tracks the Dow and they would receive a dividend slightly higher than the S&P 500 at just over 1.5%. An option that would achieve a higher dividend yield would be to purchase a fund that focuses on providing higher income and less capital appreciation. There are many high-quality options that hold stocks of stable companies that have a long history of dividends. One example is the Invesco S&P 500 High Dividend Low Volatility ETF. This provides a dividend yield of around 4%, which is significantly higher than the overall S&P 500. Instead of owning each company in the S&P 500, it only holds the ones that pay the highest dividends. Because of this, growth is much lower over the long term. With $10,000 of this fund, the annual dividend income would be around $400 or $33 per month. There are many other high dividend funds available that are ideal for older investors. The reason they're well liked by older people is because these funds tend to provide more stability. They perform better during bear markets and worse during bull markets. Combine that stability with the regular income, and it's no wonder these are popular among retirees. A second way people can achieve higher than average dividends is by selecting a sector or industry-specific fund. A fund such as this only holds companies in one single sector or industry, such as energy, real estate, healthcare, and so on. Some sectors provide higher dividends than most due to the nature of their business. The energy sector is priced relatively low and has a high dividend yield because many investors are scared away by the volatility due to economic fluctuations, renewable replacements, and regulations. The Vanguard Energy ETF, for example, has a dividend yield over 3%. Real estate investment trusts are also considered slightly risky, and because of their business structure, they pay the majority of their profits to shareholders in the form of dividends. The Vanguard Real Estate ETF also has a yield above 3%. Investors willing to do some research and purchase sectors that have fallen out of favor have the ability to achieve high returns. The returns would come in the form of dividends and capital appreciation as the sectors rotate back into favor. $10,000 invested in Vanguard's real estate or energy ETF would provide about $300 per year or $25 per month in income. Of course, yet another option is to purchase individual stocks. Although, many finance experts recommend purchasing index funds or ETFs if you're a beginner investor and don't have a large portfolio. This way, you can learn about market behavior, receive stable returns, and grow your portfolio without taking too much risk. Eventually, you might decide to select individual stocks if you're willing to do the research and take the risk. If you do decide to purchase individual stocks, it might be a good idea to look for a history of dividend growth. For example, the list of dividend aristocrats is a good place to begin because each aristocrat has a history of increasing its dividend for 25 consecutive years. A dividend aristocrat, such as AbbVie, currently pays a 4.5% dividend. If you were to invest $10,000 in this company, you'd receive about $450 per year or $37 per month in dividends. You would also receive any capital appreciation or depreciation depending on the future stock movement. Furthermore, it's smart to screen those prospects by their fundamentals. Make sure they have reasonable payout ratios, around 50 to 60% or less, positive earnings, and various other potential metrics. There are deals to be had with individual stocks because they often get sold off, whether it be due to some recent bad news, an earnings miss, or new management. This could present an opportunity because the stock market tends to overreact. A savvy investor must assess the severity of the news such as this and make their own decision regarding the stock price. Since most investors who have $10,000 are a ways off from retirement, they should seriously consider ignoring dividends entirely. Why? Because investing in growth stocks has the potential to make you much more money over the long term. Since dividend-paying investments historically have lower overall returns, those who are still young should typically seek growth. A 2% difference in your annual rate of return can make a huge difference over a career. For example, someone who invests $10,000 once at age 25 and earns an 8% rate of return until age 65 will have $217,000. If they had earned a 10% rate of return, they would have $452,000 or more than double the money by age 65. It's important to consider that growth stocks are sometimes more volatile, which can be difficult to handle for investors who are new to market fluctuations. One fantastic option for younger investors is an ETF such as Vanguard's Growth ETF, or VUG. As the name suggests, it holds large-cap growth stocks such as Apple, Amazon, Home Depot, and other large, stable names. Over the long term, a growth index will likely outperform the S&P 500, which is ideal for someone who has many years until income will be needed. The dividend yield from VUG is less than 0.5% because most of the holdings pay little to no dividend. Instead, they reinvest the profits within the business to continue growing at a rapid rate. Because of this low yield, a $10,000 investment would only yield less than $50 per year in dividends, or about $4 per month. There are many quality options similar to this fund that provide returns that historically exceed the overall market. Too often, people become obsessed with dividend yield and choose the wrong investments for their timeline. In general, an investor with a portfolio size of around $10,000 would be better off focusing on growth, ignoring dividends entirely. How much difference would the income make in your life, whether it be $50 per year or $400 per year? That amount isn't likely to amount to much when it comes to paying bills and funding your everyday expenses. Growth stocks will provide you with more money in the future when you're getting ready to retire. At that point, you could switch your growth investments over to income investments if it makes sense. Don't make the mistake of focusing primarily on dividend